in the house, put the music down for us. Hey, everybody, it is Thursday. It is 2 p.m. and we're going to start. Some of you are going to jumping from the other session we have or just had with Ed Merrill, Eric Hill, Daryl Fiedler. Was an awesome session about building wealth and about investments and all the really cool math and algebra behind it. So I'm kind of pumped about what we're going to do next, which is great. We made money, a lot of it, passive income, it's flowing, cap rates, blah, blah, all the good stuff. Now we have this money. Are we responsible enough to know how to manage it? Do we know what to do with it? Do we know how to make the cash flow really flow, or is it going to get clogged? And all the other good stuff, right? Having said that, so again, welcome to our monthly KW Mastermind session. And I have the pleasure today to host Agent Financials, pretty much. Yeah, we use the F word, financials. And we have two amazing smart, sharp ladies that have been doing this for quite some time, and I think they're going to add a lot of value to you guys. We got Michelle Scribner. She is a certified accountant. She is the guru of Profit First, which you're going to share with us in a minute what that means. And we had the pleasure to meet Michelle in person at our ALC retreat a few months ago, and that was a powerful session. And we have Jennifer Kucera. She is a longtime KW person, and she's been an MCA in different levels, currently running 2 different regions in Southern California, solving agents' issues on a daily basis, right? So share more about yourself in a nutshell, so kind of know some background, and then take us through the, kind of how-to about agent financials and what you see out there. And in addition, whoever's right now on the Zoom, feel free to drop on the chat a question, or if you want to raise your hand and ask directly, that's fine too. So make it more of an interactive, real mastermind. So with that, Jen, do you want to take it from here?
Yeah, actually, I could talk about Michelle. So first off, I'm Jennifer. I've been with KW since 2004. The reason why I would love to talk about Michelle is because I was in the office talking with one of our agents. And when you're thinking about agent financials, it's, they don't really give you a playbook. And so it's like, you make this money and now what do you do? We teach you about selling real estate, but they don't talk about saving for taxes or like things that you really need to do to run an actual business. So when I ran into the agent, Frank Kenny, he actually introduced me to Michelle. And what I love about her is that she runs her model off a book called Profit First. And that's a book that I literally read every single year regarding how you should run your financials. And so Michelle actually does the bookkeeping side, because in working with agents for so many years, one of the things that I found is that you can teach all of this, but no one actually wants to do that. No one wants to actually categorize their expenses and figure out what their P&L looks like. In theory, yes, but that actual work is done by Michelle. So Michelle, if you want to talk a little bit about yourself, I could talk about how amazing you are.
I appreciate that. Thank you so much. So yes, that is my pleasure day in and day out, is to work in companies' financial statements. But more than that, my specific job is to make the financial statements a tool you want to use, that you're looking for, you have a feel for it, but it's like actually like, that's where I am. By the time a financial statement is done, you're looking in the rearview mirror. It's already done. You can't make any changes about it. The money is already spent, but you can learn from that and make adjustments. That's where Profit First comes in, because Profit First is giving you looking through the windshield. Where is this going to lead me if I continue on that path? And what do I need to adjust in order to reach the goals that I have? Because I think we all get into our industry of choice, and especially in real estate, there's a reason why you got into it. The freedom of lifestyle, the fact that there is no top. You could keep going, and do more and greater things. And so you've got some goals that whether or not you wrote them down or you even acknowledge them besides what was in your head, there are things you wanted to do why you got into this business in the first place. And so you've got an incredible amount of resources here at Keller Williams. And now it's like, put it into action, make it happen, take some ownership over the actual inflow of cash coming in and cash coming out. And the hardest part for you is you can't guess when your next sale is going to take place, when your next listing is going to close, when escrows, when the next bidding war is that you're going to win, what the market's going to do. So Keller Williams has been fantastic to teach you other ways to have a source of revenue that comes in that you can plan on. And then what the financial statements that we talk about today, as well as Profit First does for you, is how do I make this so that I'm going to not lose sleep, not feel like I've got to go hustle or undercut myself or whatever else might happen, because it's like, I don't know when the next amount of change is coming in the door, amount of money coming in the door. All right. Are you going to talk a little bit first, Jennifer? Do you want me to jump in? Kind of tell me what?
Yeah, I could talk a little bit. I was just going to actually just mention, there is a Keller Williams class called Agent Financials, and we're kind of going into more of the Profit First, which there's also a class on that's very similar to that book that Keller Williams puts on. But the idea behind this is making sure that you guys pay yourself first, and then having your buckets off to the side as well. So that way, when it's time to come pay taxes, etc., like you have all that set aside. So Michelle's going to go into more detail about that. But again, we're going to kind of go over the Profit First book. And then I always mention this, but if you guys don't want to read a, was it 150 pages, maybe 200-page book, there's Money Bunnies, which is the children's version, which my daughter read, and that's like 10 pages. But it's the same idea where you have these buckets that you put things in. So it's like your savings, your operating account, your tax account, and you have this all laid out. So Michelle, I'll let you talk a little bit about more of those buckets and how you do that.
Okay. This is all based upon sound business principles in the sense that think about our grandparents, that they got paid in cash or they got their paycheck and they had to make it last throughout the whole entire month. And those of our grandparents who were wise took that $1,000, which was a lot of money back in those days, and had different envelopes and said, okay, my rent is going to be $400. They took $400 and they put it in the rent envelope and they couldn't touch it. It was over to the side. And then they took and said, all right, it's the summertime. We're in California. My utilities are going to be $100 this month. And they put it aside. Coming December, they might only put $50 aside in that envelope, and they set it aside for when that bill came due. Then it was how much was there going to be for groceries, for insurance, for whatever else. And then in a case of like, let's talk about insurance, where insurance was a once a year thing. It was like every month I'm going to put $10 in this envelope for insurance and set it aside. And it just accumulated so that when that insurance bill came due for the car in every 6 months, you pulled out that envelope and there was enough to pay the entire premium. That was in the days of cash, and cash is still what we want to be operating in, so that you are not having to figure out how to borrow the money or stress about what am I going to do because you don't have the cash. So that's the underlying principle. So what Mike Michalowicz did in Profit First is said, how are we going to make this for businesses? Because we're not going to use envelopes. We're going to use bank accounts. And so as much as it seems like it would be a really cumbersome thing to have several bank accounts, I want you to think of it in the sense of having an envelope. It is this program or this methodology is behavior based. So our grandparents would never touch the envelope, even if they wanted something, because they lived through the depression and they lived through the day that you lost things if you didn't have the cash. Their behavior was so grounded. So now what each of you have to look at is and say, what is my behavior? If I had it all in one bank account, would I be disciplined enough to make sure that I don't touch that? Or do I physically need to move that money so I don't see it, I don't count on it, and I just let it grow? So I'm going to say in the clients that I work with that 90% of the time, if they don't open up different bank accounts, they fail, they cheat, they do something because it's just too easy, or it's just more work to remember, like how much of this is supposed to be, you know, with the spreadsheets and whatever else. A bank account, it's cash, it's gone, and they don't see it. So I'm going to share my screen here and we're going to go into what these accounts are. Now, what Mike did in the book is he created and looked across the industries that are out there, whether it was a dentist, a lawyer, a real estate agent, hairdresser, and such, and realized that there are some principles. And again, you're going to hear me go back on the principles because that's what is the tried and true point, is the business principle. And realize that for businesses that earn this amount, that we're going to go over these percentages, that this rang true regardless of what industry. And for businesses that earned between $250,000 and $500,000 a year, these percentages rang true, and so on and so forth. And I'm going to go through the thought process of that. So think about where you are. Use your historical data if you've got that to say, you know, every year I make $500,000 in commissions or passive revenue, or if you're flipping, that's what you're making on the gain. Whatever other ways that you are earning money, true money that comes in, if you've got investments and there's interest that's coming in. So, and look at where you are on the revenue that is actually your paycheck. That, I mean, and paycheck is not the word I want to use, but what you truly earn. And think of this in the terms of your business. So you, each of you as an entity in your own business. This is saying that 100% goes into the bank account that we call the income account. Every single penny goes deposits in that income account. And then from there, depending upon what bracket you're in, or what column, as you can see here, you then will transfer out into your bank account called profit, thus the profit first, 5% or 10% or 15% or 10% or 15%. And what this looks like is, because you have taken the risk of going into business for yourself, an entrepreneurial mindset, instead of just taking a paycheck by going and clocking in every day and taking a paycheck, this is what the profit is for you. This represents the fact you went into business to make money. And so it's the blood, the sweat, the tears, the return that you should expect to receive off of that business. When you're making this small amount, it's going to be small. As you grow, it should be more and more. And then look what happens here between the 1 million and the 5 million mark. It goes down. Now, remember, this is percentages. So it may not be down in the dollar amount, but at this point, you are making a lot of money and you are doing less, and it is more stable, and you can expect to have this in for this next period of 1 million to 5 million. Then it jumps greater. And when it's at this point, all you're doing is being the owner of the company and receiving profit, because right here, you're not taking a paycheck for yourself for any work in the business.
Michelle, do you mind just to, hold on. Sorry, do you mind just to zoom in just a tiny bit?
Sure.
Thank you.
How's that? That better? All right. Thank you. And please interrupt me at any time because I can see some of your faces, but not all. So the second thing you'll do out of that income account is transfer over the amount that you should pay yourself. And when you're running a business and you have employees and you have expenses, one of the things that happens for business owners is everybody else gets paid except you. So we put this second in line because I want to make sure, as does everyone who is running a business, that you pay yourself. You're usually in this bracket here doing half of the work or all of the work. You're a solopreneur. You're the one addressing envelopes. You're the one scrubbing the toilet. You're the one that's paying the bills and answering the phones and whatever else. You're a one-man show. And then as you get greater here, and again, it is a percentage base, so it doesn't mean that you're taking home less dollars, but it means that you're doing less work. So now you can hire someone to answer the phones or for you to go and make the calls or put in the marketing material or whatever else it is, data input. At this one, you're probably doing your own bookkeeping. This is the time where you can bring somebody else to help you with your bookkeeping or whatever else, paying your bills. As you reach this threshold, you pay yourself less as far as a percentage and transfer less into this owner's pay account. And then again, that you're going to be outsourcing more until you're finally at this level. You're doing nothing. You're sitting on a beach in Hawaii and your whole company is running itself and you're collecting 20% of everything that comes in the door because you're doing nothing.
I think most people actually do forget to pay themselves. So this is the most important one right here, because what happens is you hire an assistant or you hire, VA, whatever it may be, and then you stop paying yourself or you're not getting in that income. So that's the one that I see the biggest issue for people.
Okay. Oftentimes, now realize that both of these are meant for you to put in your pocket, to take home and to live off of. And so oftentimes, especially those that live in higher priced areas, like in California, then I say, what do you need in order to come home and live off of? And we kind of start there to say, is it 60% here and 5% here or whatever it is, because at the end of the day, this is meant for you to take home and enjoy. This is meant to be used on a monthly basis. This is meant to let accumulate for perhaps other goals and then to pay yourself out on a quarterly basis. Then we've got this beautiful tax section here. And this is the tax account is meant for your taxes as a business owner and an individual. It is not the taxes, the payroll taxes on your employees. It's not your property taxes. It's not any of those things. It's for your taxes. If you worked for another company, then they would be taking out taxes on your pay. So if you're not on a salary in your own business, or even if you are, you might not have set aside enough taxes. So we start at 15%, but most of the time I'll ask you, go back and see how much did you make last year? For those of you that just filed your tax returns, what was your revenue last year? How much did you earn? And what percentage did you pay in taxes? And we start there and say, okay, you're in the 20% tax bracket, whatever it might be. And we start that with the percentage that was real for you. And then we ask the questions, do you expect to make more this year? Like in all reality, do you expect to make less? Are you having what other situations in your life as far as the way your status, whether you're married, have children, own your home, all of those things factor in. So if anything's going to change in this current year, you might have to change this percentage. So at this point, these three things here, for every $1,000 that comes into the company, these percentages are what should be going to you as the business owner. Now, what this means is that you've got to be very disciplined and realize that that leaves only 30%, 40%, 50%, 65% for you to pay for operating expenses. And what are those operating expenses? It's the TC fee you pay to somebody at Keller Williams. It's the contributions you pay when you pay for the Sunshine Fund or for other contribution. It's your telephone. It's the meals that you pay for taking a client out. It is all of the pieces that makes your business unique. So if you are making $10,000 on average a month, then you only want to be spending $3,000 in operating expenses so that the rest is there for you. As you make more, you've got to spend more until you're here at the million. And this is where the biggest piece, because we know from 1 million to 5 million, you have to spend more in your business in order to be able to grow and to be able to move forward. And that's where these percentages change. From then on out, it's 65% across. So I want you to think in this way: at no point in time will a fiscally healthy company pay more than 65% of what comes in the door on expenses, employees, rent, utilities, all the things that go in that P&L. Any questions so far at this point? This is where you start and you say, all right, what are my expenses? Now, as a real estate agent, your expenses are steady. Whether or not you have a sale, you have to pay your VA. Whether or not you have a sale, you have to pay for your telephone or your rent or all those other things that you're thinking. Every month you have to pay that same amount. So you could go in and say, my monthly amount, we kind of say, what's the nut I have to crack every month? And let's say that it is, my total expenses are $2,500 a month. If you're in this bracket, then that should only be 40% of your average revenue on a monthly basis. So that means if your amount is $2,500, that's 40% of $6,250. So you take all of your sales for the whole year and say, I've got to earn at least $6,250 in sales in order for me to pay my $2,500 nut that I have to crack. So as a real estate agent, you've got to think really strategically. And oftentimes what will happen is you put your percentages and you split it out as this, but on the operating expense, you only bring over the amount that you need to pay each month, because you know if you make an amazing sale and a whole bunch of money comes in, it has to last you several months sometimes. And so most of our behavior, and this is where your behavior really comes into play, are you going to spend because you see the money there? Or have you experienced, oh my gosh, I ran out of money, I have no sales, and you know what that feels like, and so you don't. So in cases like that, either open up another account, and we call it the drip account, and just say, I'm putting all of my operating expense there, and monthly I'm only bringing over my $2,500, so I stay within my budget.
That's really helpful, because if you only have like the 3,000 to spend, guys, then when you're moving it over, what you do is you won't spend more than that in theory, because you're looking at your bank account and you only see 3,000. And that's what we teach market centers as well, is to only move over your operational expenses, and anything above and beyond, we call it a variance. And you have to get approval for that. Now, obviously you guys are yourselves, so you would have to approve it yourself. But the idea is to not overspend and stay within your budget.
I do have a couple of questions, Michelle. So what's the difference between owner's pay and profit?
The purpose, that's the difference behind it. The owner's pay is when you have a company that you should be doing less and less and less. This is what it would take to replace you. So you're kind of unique in the sense that you are agents unto yourself, right? But at some point, say in the case of a car wash, the owner does everything. And if something happened to that owner, then it would take this is what it would do to replace them so that the company could continue to operate without them. That is that. So this, for real estate agents, this is what it would take if you wanted to bring in another agent and say, I'm just going to pay you a salary and I'm going to do nothing. This is so that you could just replace yourself. That's what the purpose of the owner's pay amount is.
Now, if someone want to make, start to build their savings, right, for the next 6 to 12 months, is that being taken from where? From the profit, owner's pay, expenses? How do you factor that in?
That great question. So I'm going to come over to another one of the tools that I use.
More secrets.
What's that?
I say more great secrets.
More great secrets. All right. This is my little handy dandy calculator that I like to use. So when you make a sale and your commission comes in at 105,000, you plug it in. So let's just say it was 108,500. Then it does all the calculations for you. And then you populate that and change it over to what your accounts are, into your profit account, your owner's pay, your taxes, and your operating expenses. And I just use the bracket of the 250 or 500 to 1 million is the one that I used for this. So, but you change these percentages based upon it. Now, if you have debt in your business or debt in your business, so if you have a small business loan, if you have, what are some other things? I'm going to even say, like, if you have a property there that you want to, properties are different though, because it's backed up with an asset. So anyway, any debt, let's say you have credit card debt in your business, then it has to come out of this operating expense. So sometimes we create another account for debt payments because you've got to capture that. That monthly payment is taking away your cash flow. And the whole purpose for Profit First is so that you don't have a cash flow problem and you're not scrambling around like, oh my goodness, I don't have enough money to pay the IRS at the end of the year. So as I come over here, then I say, what are your goals? And this gets down into what do you want? So if your goal is, I want to buy a home on the North Carolina beach, and it's going to be $350,000 because it's not as expensive to live on the beach in North Carolina versus California. And this is my beach house. Now, this would be the current balance. And when we have here that the current balance that we put in was 16,275, and you're looking at your goals, you're going to let this grow and grow and grow because the next sale that you make, it's going to be greater. And you keep your eye on the goal. And I ask all of my clients, get everything out of your head. I want my child's education paid for. I want to have my house paid off. Whatever it is, all of those things for what you would do with that profit so that you don't spend it, that you're reaching the goals of why you got into this business in the first place, that there is no limit to the amount that you can make. But we all know you make more, you spend more, don't you? Unless you say, no, I've got some specific goals and you don't touch that profit account. So now we get into this owner's pay. And again, the owner's pay is a percentage. So if the next month you make $250,000, you've got $50,000 there. So again, coming into what is the goal, then the goal might be, I'm going to live off of my $20,000 a month, and I'm going to let my owner's pay grow because I want 6 months of personal living expenses paid for in the bank. So that if another COVID hits or another something happens, you're like, I know for 6 months, and let's say that it costs you $15,000 to live, to make your house payment, to feed your family, whatever else that is. And you let that grow, grow, grow. So you take out the 50,000, say, yeah, I'm going to take out my $20,000 that I usually take. And now that's going to grow over time as well. And when you hit that, you're like, very good. What's the next goal that I want? And usually taxes, there comes a place where you say, okay, because it's all percentage based, then you can say, you know what, my tax bill last year was $75,000. And so that is my comfort level. So at any point you can say, I know I'm going to keep on putting money in there, but once it hits that, then I can move it out of the taxes into the profit account, because after you pay your taxes, whatever's left in there is yours. It's kind of like getting a tax refund. In fact, it is the tax refund, because that's what a tax refund is. You paid the government instead of your tax bank account, and they gave you your own money back. So that's what you're doing to yourself and saying, you know, I can see I'm going to be okay, because you're not going to pay taxes unless you earn money. So you find out what your comfort zone is. And this may change. This may change based upon illness in the family, divorce, being uncertainty that comes along. And so you just keep on adding to all of these pieces. Now, do you see that this is all green or yellow or whatever this color is? To say, this is you. This is you as an individual, not your business. It's you, to take care of you. Then you look at your business. This is the blue area. And you say, what do I want in my business? So this is where I said, if your monthly amount is $2,500, and you might want 3 months worth of operating expenses at all times. As long as I have $7,500, then I'm okay. And that's going to, so you let that operating expense grow. Once it's at 7,500, then it's like, okay, now I feel like I can bring on another virtual assistant, or I can bring on a marketing director, or whatever else you might want. In order, because you can say, hey, I've got enough money. Because remember when we talked about that your expenses are going to stay the same, and as your revenue's going up and down. So you have to decide, what is it here that's going to make me feel okay to spend some more money if there is more money? How much is your comfort zone? And then I've got people all the time saying, I want to own my own space. So most of the time the business isn't going to own it. It's going to be another wealth creating thing, or maybe it's a larger space, or maybe it is bringing on your own moving van so that you can help. Please don't help people move. That's the worst thing you could ever do. No. Could you imagine? Yeah, I'll help you move too. No, but whatever it might be, and you have these business goals. So for us, like I'm at the place in our business where I am ready to bring on another high-end manager to then delegate more to me. I know the salary is going to be $7,000 a month. So I'll make sure I have $21,000 set aside before I bring them on. That gives me 3 months, because we all know that sometimes they sink and sometimes they swim. And so I know I'm not going to go behind. I'm not going to go into debt. I'm not going to freak out. I've got that extra cash setting aside. Now I can bring them on and I can adjust. So COVID taught a lot of companies this, and the people that were using Profit First soared through COVID. Why? Because they didn't think about, what am I going to do for cash? It was already taken care of. Yeah, it was a fleeting thought, but they could focus immediately. Like, what do I need to do in my business right now? I've got my cash taken care of, at least for a little while. Now, what do I need to do? And they could strategize on the thing right at hand and not worry about the cash part. So this is not a fancy schmancy thing. It's a list of you just getting it out of your head and having it in front of you. When I'm working with the client, I'm holding them accountable. So when they say, yeah, we're going to go on a vacation to Europe, and we're going to use the profit. Then I come back to them and say, is that what you want more than the beach house in North Carolina? And they say, no, let's put off that trip one more year because I can attain that. Or yes, it is. And we change the goals around. This would, in the operating expense, another thing might be another piece of equipment. Say you want your own photocopy machine, or you want an extra, I don't know, whatever it might be, so that you, and that chunk of change. So does that help answer some of those questions, Meny?
Yes, thank you. And Emilio, and wherever else, at some point, Michelle's going to type in her information, so you can reach out to her afterwards to get some consultation, whatever, just to understand what she can help you with afterwards. Yeah, go ahead, Michelle.
So the thing is that when you start realizing, and like you just had the wealth you came right out of a wealth workshop, right? Of creating wealth for yourself on other ways. So the more diverse you are as far as your revenue coming in, the more that you can count on. And so if you know that every month you've got $10,000 coming in because you own an apartment complex and that's the rent, then this is how it typically would be. But in the case of a rent, you're going to have some, it's called materials and subcontractors in the book. In bookkeeping terms, it's called cost of goods sold. And immediately when you've got an apartment complex that you have, that let's say you own it free and clear, so that's all coming in, your operating expenses might be that you have to hire a landscaper or someone to fix the pool, the repairs and maintenance, or whatever else it might be on that. So your materials and subcontractors would be things that you do not have any control over. And in this case, I'm going to say that property taxes, even though that seems very odd that that's what it is, that's something that is going to go with owning any property, and you can pull it out immediately. So let's say the property taxes on it are 10%, then you might pull that out completely and then split out the rest of your pieces. And this would be a completely separate account of knowing what needs. So then, I need to operate the rest of this, because the more buildings that you own, the other things that might be just solid things you have no control over, it just has to pay. It's not an operating expense. It's just that's part of owning a business. Very different than whether you've leveraged yourself with debt or not. That needs to be factored into the operating expense piece, the debt part of it, and not up here, so that you haven't over leveraged it. And I think you've all probably done it. Like, is this going to give me, what's my cash flow going to be on an income producing piece of property? So this also allows you, when you are looking at your goals long-term, to say, this is something I can always count on, and you can still do your percentages based this way, in addition to the commissions and such. So most of the time, what I am working with people is September comes around and you're like, I got to get through. I only have 2 things in escrow. They're going to be closed in October, and we're getting into Thanksgiving, Christmas, and January, where you're like, okay, I don't know what's going to happen there. That's a little bit too late to start. So if you are reaching up to that point, and one of your goals might be on here is, I always want my November, December, and January, which is your 3 months, and say partial February, enough there for you to have already in an account, so that always you're going to be able to get through those, regardless of if any sale takes place with a commission that comes in. And this is so that you don't have to turn off your phone. And you don't have to let your virtual assistant go. And you don't have to shut off Google or whatever software you're using.
Any questions, anybody?
Yeah, thank you. I was muted. Yeah, questions, anybody so far? You might have something. Don't be shy to ask any questions, right? This is the time right now, because we have, 2 superstar, left brainers over here. So
I was gonna say, I dropped the book link inside there, and then I can also drop, Michelle talked about the expenses, because that in itself is a whole class, but I can drop in the link of what we call chart of account should be, because we teach the MRA book, and that in itself has percentages on what you should be spending, etc. If you guys have questions on the expense side as well.
And just to point out, right, because I'm an agent, right? So I know how that works, and how one might think. Maybe if you've been in the business for quite some time, it's going to be different, because you're learning, you're studying, etc. But most agents, they have an issue with understanding, right? Especially if they moved from maybe a different type of industry, or not self-employed, etc., to the fact that, now I'm the boss. I need to pay myself, right? Anybody else have this issue in first position? I'm the only one. Okay, there's a few out there, right? So how do you overcome that it's okay to pay to yourself first, which is the entire concept, right?
It is. The two things that why Profit First came about, and the two things in work, like when I'm one is the stress of cash flow. It's the number one reason why small businesses have to close their doors. So if you have payroll and you can't make payroll, the consequences of that are severe. Besides the fact that emotionally and mentally you start to crumble, it is extremely stressful when you don't have the cash. So any of you have experienced that, you know what I'm talking about. That's the number one thing that this overcomes. The second thing is entrepreneurs are notorious for not paying themselves. And so you love what you do. I would do it for free, but you know what? You have expenses to pay. And so why not just go get a paycheck from someone else, be done and clock out at 4:30 or 5 o'clock every day, and then just go love your life and not have any stresses associated with it. Because if everyone else gets paid except yourself, then you are taking on the weight of the world in order to take care of everyone else except yourself, with the dream that one day I'll make it big, one day I'll make it big. Well, if you don't start the habits from the very beginning, it might not ever happen. Or I know people that they've gone into debt. So then all of a sudden you really aren't paying yourself. And now you're shackled with debt. So there's big dreams associated with going into business for yourself. And there is also a big risk involved. If you do not get in the habit of paying yourself from the start, it is harder and harder and harder to justify it. So the other thing is, when you work for yourself, you have to take care of your retirement. You have to take care of all these things that typically an employer might cover for you. You're very fortunate to be with Keller Williams with resources that are there, but the typical entrepreneur does not have any of their future planned for. Their plan is, I'm going to sell it big with like Google, and I'm going to live right. And you know how many think that, or my kid's going to take over. Well, that's not always what happens. And so you've got to say, I've got to take care. And you know that time is on your hands if you start at the very beginning and use time to get yourself in that position.
And I was going to say the number one thing that I think people fall into is not having the different bank accounts, because when you're paying yourself, you need to move that money to your personal banking, because otherwise what you see is you just see the $20,000 commission check in your personal bank account. And again, what Michelle said is you just spend it because you look at it as that's how much money you have. So all of that goes into the owner pay account, or when you're moving that money, that owner pay is your personal account because you're paying yourself a salary.
Yep.
Yeah. Other questions?
So
yes, hold on, one question over here. Yeah.
So OPEX is what you'll use for holidays or for I'm not too sure what OPEX is. Better.
Can you repeat? Yeah, Michelle.
Yep, that's great. I'm going to use a visual on this. And I also want to say that this is your target. When I bring on clients, there are clients that their operating expenses are 98%. 98% of what comes in, they're paying everything else on. I had one, they're paying 102%. They were hurting. So this is what you're aiming towards. You might not start there. You might have to say, what am I starting with and how am I going to get to this in a systematic way? So I'm going to use the example over here. Let's go into, all right. So on a standard chart of accounts, this is a profit and loss. It's only part of a financial statement, but this is going to let you know what your operating expenses are. And when you're using QuickBooks, everything is in alphabetical order. So there you go. That's the order of it. Now you can rename any of these accounts to be something that means something to you. So let's take, for example, you've got a team, yourself, a virtual or an assistant, someone who's helping you with marketing. Maybe you've brought on another salesperson onto your team, whatever it might be. So the fuel, and this happens to be for like a whole quarter of funds. So these are all operating expenses. You need to budget for how much fuel you're spending. You need to budget for the maintenance on that vehicle, if you're paying the maintenance on the vehicle, and then whatever parking and tolls that you might have. And then if you've got AAA or you want to run car washes through it or whatever else, you've got, those are all operating expenses. Operating expenses is what you would put in for charitable contributions, or if you're going to sponsor a golf tournament or whatever else might be as far as your things for charity. Whatever dues you owe, it's that lovely every 4 years. I mean, if you're paying MLS dues, if you have to pay for, our real estate licenses to renew, that would be under your dues there. Now, dues and it used to be called dues and subscriptions. And in most cases, I eliminate that completely, because it used to mean that you had a subscription to People magazine that came in and sat on your coffee table in your lobby. Nowadays, everything is subscription. So I encourage you to make yours, either use Keller Williams, they've got an amazing chart of accounts, or you rename things like, what is this for? What is this really? So when you see 230, I'm like, oh, I know exactly what it is. It's my dues to the Chamber of Commerce, it's my dues to the MLS, and it's my dues to the Department of Real Estate. That's what that is. And it's not so, because when you're watching every single penny, then I need you to know what this is. That's what that is. That's what that is. And as soon as it goes to 245, you're like, wait a minute, why is it 245? What happened? Oh, that little thing snuck in there. Oh, the Department of Real Estate paid, they raised their rates, because you're looking at, like, you want to be on top of this. Here's your continuing education, executive coaching that you might take, an extra class that you might say, I want to. And this is an area where you're like, I know you have to do your continuing education. I also know that for $99, you can get it all done. Or you can go to Las Vegas and have an amazing weekend and spend $1,200 and get it done. So your continuing education, based upon what percentage and where you are in meeting your profit first goals, are going to determine how much you should be paying on a very discretionary amount. Still has to be paid, but whether it's the weekend trip someplace fun or the $99 course that's online to get your continuing education done. You've got all sorts of insurances. All of those need to be calculated in your operating expenses. If you're paying interest on a credit card or interest on a loan, that is an operating expense. That's why I want your debt gone for you, so that you've got that much more cash to use. Internet, technology, your fees with Keller Williams. And then we get into those things that give you leads. So advertising, postage, whatever it might be. Coming down, if you're giving out gift cards, or you are showing appreciation to clients, or taking them out to meals, might be under here. And then you've got your meals and entertainment. If you've got a business equipment that you have a lease on, or you're renting something, postage machine, copier, printer, whatever it might be. And then you've just got those wonderful things called pens and pencils and Post-it notes and whatever else. And those just all add up. This owner salary, even though it's on your profit and loss, in a profit first world, that's being paid for out of a different bank account, yet it still shows on your financial statements. This is where I'm looking and saying this person pays themselves a salary and has their payroll taxes taken out. But they also have staff wages, and they also pay a payroll company to do all the payroll. So anything that has to do, now the taxes of the staff are an operating expense. You are a business now. That's the difference between paying someone as a 1099 contractor and bringing them on as payroll. Either way, it's an operating expense. It's something you've made the choice to operate your business in that way. And Profit First lets you see, can I afford it or can't I? because you'll know, well, I only have this much money based upon my percentages. Not yet. It looks like I've got to do that work, or something else has to change. Then if you've got accounting and tax prep, if you've got banking fees, if you've got a profit share or retirement, if you have rent, here's another client relations, copies, and then your telephone and utilities. So at the end of the day, we look here and say the total expenses, and I need to take out minus the salary.
You don't have to learn Excel right now, so don't get stressed
No,
out.
I know, don't do this. So this person, this financial shows that their operating expenses for the fourth quarter were 51%. That's pretty dang good when we're aiming at 50. Pretty dang good.
Yeah. Yeah.
That's how you know. That's how you know what you're operating. And the only thing that's not showing on your profit and loss is the debt payments that's shown on your balance sheet. So you've got to remember that if you've got debt payments that you're making.
Yeah. And by the way, if this is again, like, seem to be somewhat stressful for a second, intimidating, right? First of all, maybe you don't have that long of a
No.
lot of accounts and whatever, but start somewhere. It's okay if some of those things, those items are empty. Like, you don't have to be there full. What's important is to understand that you need to be there at some point. So start small, and then you can build it up, right? Another question. Sorry, go ahead.
Where you start is right here, is that you have everything that you would want a business to pay for being paid for out of this bank account called operating expense. And I told someone the other day, I want you to think that you have a left pocket and a right pocket shoved full of cash. If you take it out of the right pocket, it's your money. Hey, I want to go on a vacation. If you take it out of your left pocket, it's something the company should pay for. So if you go and you say, I need to get a Google Suite membership or Adobe Cloud membership, are you going to pay for it out of your left pocket or your right pocket? If anything that has to do with the business is right here, anything that is for you, where you wouldn't expect a business to pay for it, will be paid out of here. That's where you start. You don't have to have a chart of accounts like that. That's just taking it one step further for decision making, because we all say, where the heck did my money go? And how many of you pull your bank statement and say, oh, I can see where it went? No, we don't do that. But if you can say, all right, I know that I only have $4,500 in there. When it gets low, you're like, oh, I know where my money went, because there was only 4,500. There wasn't 10,000 in there before. You're like, oh, you stop. There is a natural stop. And then you have to make the decision. Do I pay that next bill out of my money? Or do I say, I need to cancel that because I don't want it coming out of my money?
Well, and that's the other great thing about having a P&L and actually looking at it and knowing where your money is going, is a lot of times you're going to start paying for things, for subscriptions, for leads or other things. And then you're going to realize, like, hey, I actually make more bang for my buck by door knocking. So I need to reevaluate my expenses and put it towards door knocking, because that's where I'm making my income from, versus, let's say, like mailers or something. It just depends on, what your strategy is.
Another cool thing to do is to reverse engineer it in terms of the big picture. Meaning you can say, I want to make that much. I want to get there. So put those numbers, and then it's going to show you pretty much, right? I'm not sure if there's a way to kind of put the there you go, income right over there, and then then you can see like how much you're supposed to allocate to every big item, right? It might wow you for a second. Oh my God, that much, 75,000 in taxes. Like, I'm not even making a year 75,000 if you are employee for whatever company, right? Or just starting your career. However, that's the mindset you want to get into, right? Because then you can grow into that versus the unknown. So pretty much this is not an option even. This is part of what us as business owners must do. You have to be committed to it. And guess what? The good news is, if you're uncomfortable, congratulations, right? That's being an entrepreneur. And if you're uncomfortable, you got people like Michelle out there in the world that you can leverage, put her in your Apex account to know that that person will run this for me, etc.
Yeah, what we do day in and day out is create that financial statement. So you don't have to. We put it in where it belongs and then review it with you. And then if it was, let's say 75%, then we go in and say, how much on a monthly basis do we need to shave away? And where could it be? And dive down into it and say, oh yeah, I signed up with that 1999 software and I thought I'd use it, but I don't. Because you've got someone holding you accountable and saying, go cancel it right now. I think I've shared this with you before, but I'll say it again. There in college, I was asked to give a presentation on wealth and about managing and budgeting. And I kind of studied all of the most successful Rockefeller, JP Morgan, all of those that just made huge amount of wealth, to see if there was something that was the same for every single one, like what was the underlying piece. And I found it. And every single one of them said, I knew where every penny went, not where every penny came from, but when every penny went. They were aware of their expenses. And you know what? They had mansions and they had servants and they had all sorts of stuff. So they didn't say, well, I watched what I spent. They knew it was a conscious choice. And what Profit First is it makes a conscious choice of what you're going to spend and what it is and how you're going to pay for it.
Yeah. Is this helpful, by the way? Yeah, to get an idea like where you can go and grow into. Other questions? Zoom people, real people. Okay. Anything else to just to sum it up, Michelle, Jen?
No, just that I dropped some links inside there. Again, the book and then the Keller Inc. resource page for the breakdown of expenses for people. And then also I just wanted to plug that we are having the shift class on July 27th with James Scholl. The place is to be determined, but just make sure you earmark that, because we also will talk a little bit about expenses on there, but remargining your business as well.
Yeah. Thank you, Michelle.
All right. Everything I've shared with you today is in that book. And it's kind of just like, if you want to be fit, we all know what the things that we're supposed to do. You eat healthy, you eat healthy and you exercise. Those are the two things. So there isn't anything magic about this. And the book gives you everything that you need, including this, all of the formulas that I've given you and everything else. It's all there for you. And so what we've done is we're that physical trainer, the one that holds you accountable, the one that says, hey, let's shape up this portion, or let's work on this right now, or let's see where your pain points are. And I'm just cannot stress enough for you to really tap into your personal behavior and what you do that sabotages things or what catapults you forward, and really, really take that into account as you go forward with all of this. It's a big part of this whole, the success of this.
Right. I actually just dropped the Profit First link inside there as well, guys. But like Michelle said, we say all this, but then it's actually doing it. So that's where Michelle comes in.
Yeah. But you don't need me in order to be successful with this. But if you want someone to take your hand and walk you through it and be by your side through it all and keep you organized and accountable, then that's kind of where we come in.
Yep.
Awesome. Good stuff, really. And thank you for sharing all the resources and the links. And Michelle, did you want to put in the chat your email so people can, if anybody want to reach out and ask more, acquire more. Again, it's part of business is also to understand how to leverage.
Yep.
Right. And,
So that's my direct number. I happen to be a licensed real estate agent as well, since I was 19 years old. So it's nice to work with people that we can speak the same language as well. So.
Great. Well, if you don't have any other questions, then you guys can kind of copy it over here, take a picture, what have you, on the chat. Copy Michelle's information. Michelle, Profit First, Jen, MCA Angel. Thank you, ladies.
You're welcome. Thanks for having us.
Yeah, thank you so much. Thanks everybody for watching us, and until the next session.